First off, though, thanks everybody for being here today. And so we're going to talk about earnings. As an option trader, it's one of my favorite times a year. And it happens 4 times a year, so get a lot of volatility, and it's something that I really enjoy because it gives you a lot of great opportunities. So we're going to talk about some of those opportunities here today. And again, thank you for being here. So we're going to talk about 5 steps for earnings season success, and this is kind of how I go process that I go through. So it's first, how to find that volatility and use it to your advantage, and then a screening process that I use to find really good high probability winners for the certain strategies that I want to use. And then I use a 7-step kind of checklist that I go through to make sure I'm doing everything properly. I like a lot of structure in my systems. And then I'll show you my favorite trading tools for earnings, and then I'll show you my one favorite trading strategy that's a non-directional strategy to use. So first off, the following webinar is purely for educational purposes. Any stocks, futures, options mentioned does not constitute advice and should not be construed as recommendation. Well, I've been actively trading for over 30 years, and I was executive vice president for one of the largest oil trading companies in the world and ran their international trading desk for over 10 years there. So it was a great learning experience for me, and trading is that journey of learning. So hopefully you guys will pick up some things here today. I went on to open a over-the-counter crude oil options brokerage desk for PVM Oil out of London, which was or still is the largest privately owned oil brokerage company in the world. So that was another great learning experience for me to learn a lot more about options. And then started my own company here, so it's a totally different thing when it's your own money at risk, and I've learned a lot about that and different ways that you have to change as far as your trading goes. So the one thing I'd like to just pass on, though, before we get started is that to me, controlling your risk is the most important thing that you can do in your trading. And if you're able to control your risk, then you're going to be able to have those profits come in. So you want to protect your capital, and the best way to do that is with really good risk control, and that's what options really give you. So that being said, let's move on. Ask yourself this: what if you could add a new income stream now? Would that change your life? And if the answer is yes, then you have a plan to achieve that goal. Now, developing a new income stream, it can take you years to achieve, considering all the education and work that goes into something, that's required to, do a business or a new business. But what if you could, learn in only a few hours how to add a new stream of income by creating option spreads to capitalize on stocks reporting their earnings? So if you're ready for this, we're going to move forward. Now, have you been confused by the weird movement in a stock price during its earnings announcement? Have you noticed how earnings can be horrendous and the stock goes up, or earnings can be off the chart fantastic and the stock goes down? This is what I call the earnings confusion. Now, when a company has its earnings conference scheduled, many times there are going to be, speculation not only as to their earnings that they're going to have released, but also as to things that are going to happen in the future at the company. And we saw a great example of this with Apple back a couple of earnings seasons when they announced a 7-for-1 stock split at their earnings call. So you get this, pin-up potential volatility from the unexpected or uncertainty, and this is where you can really take advantage of that as an option trader with certain non-directional type option spreads that are available. So it's this uncertainty that causes this volatility in the shares themselves, and that's the diamond in the rough for us. And it's that temporary parabolic increase in the exchange listed options of the underlying shares. Now, here's what happens. Now, traders will tend to stay on the sidelines as much as they can going into the earnings conference call, but then all of a sudden they realize that maybe they're too overexposed, too much shares here, and they want to get some better control on that. So they'll swap out their long shares and they'll buy options, they'll buy calls or something, because they still want to participate in any potential rise, but they want to limit their potential downside risk too. So by doing that, they can exit some of those shares and buy calls. Now this is what pushes up that demand for those options and increases that implied volatility, and that's what pushes up the premium. So, this really causes those call options to trade in many times at drastically expanded levels. And additionally, it puts the buyers, all this demand coming in at one time, and it really spikes it up higher. And then again, you also have the put buyers coming in because they want to protect their downside. So you have all this demand coming in to buy calls and to buy puts, and that's what increases your implied volatility, and we'll show you that just in a minute. So, as an individual trader, you can take advantage of this uncertainty and volatility, in order to capture those profits, no matter, what those crazy earnings reactions are, if you just use the right type of setups. So step one, though, is to identify and qualify a particular stock, and you do that by, I do it by looking at the past performance of those particular stocks as they head into their earnings release. And you want to find those stocks that have their earnings release closest to a weekly option expiration or a week of a monthly option expiration, because, what I've noticed is that I used to use the monthly options, but these plays can spike up real fast, and then all of a sudden they'll stall and price will come back down. So there's so much volatility and momentum initially pent up that it's better to use the real short duration options to take advantage of that temporary parabolic moves that you get. So for that reason, I like to use the weeklies, or I'll use monthly options as long as it's in the expiration week of that earnings release. Now, you want to then, step two, look at past performance to see what volatility is done to a particular stock that you're looking to trade into an earnings. And you want to see, basically you'll see three types of potential trade setups during an earnings cycle. When I say earnings cycle, I mean earnings season. So first, a lot of times you'll see certain stocks will trend right into their earnings release, the day of their release, or a couple days before. And then you're going to see an earnings release type of explosion up or down, or volatility collapse. So I call that the second trade. That's a non-directional trade that I use. And then the third type of trade is another trend for post-earnings release. So you'll get, a lot of times, three opportunities on one stock around an earnings season, which is, great for a trader. So the smart trader, you want to look for this dramatic increase in the front and second month volatility prior to the earnings call or earnings release. And this is known as an increase in the volatility skew of the option. So a stock's front month volatility, you'll notice, probably normally has around 25 or 30%, but when its earnings are a couple days before expiration, that volatility can easily move to extremes. So here's an example. Here's SanDisk, just to show you what that implied volatility can look like going into earnings if you're not familiar with it. So if you look at SanDisk right here, you'll see, the normal earnings down here is, not normal earnings, but normal implied volatility in this column is around 35% roughly for SanDisk. But as it gets into this particular earnings release, 3 days to expiration, you can see it popped up to over 72%. So this is, what you're looking to take advantage of, and that shows you, that increased implied volatility, which shows you that there's going to be some good volatility in SanDisk going into its release. So here's another really good example. You can see that here SanDisk is one of those stocks in this particular cycle trended up. So you can see a nice channel trended up on price. And then as you get into earnings release date right here, you can see that it came out, and that trend to the upside all of a sudden was halted and it gapped down. So over here you can see the implied volatility also cycling up, trending up into earnings, and then collapses after the release. So in this situation, you had a chance to take a nice, say you bought long calls, you would have had a nice trend up, you would have got an increase in the call premium by the delta of it going up, and also that implied volatility pushing up also helps increase that premium. So, a twofold effect there from implied volatility moving up, plus that stock cycling up, and then a collapse, and then sideways action there. So here's another kind of example, and this was Amazon. It tends to have some really good trends into earnings, and then it's a really great one to trade for an earnings release. And here again, you've got that Amazon in this particular situation back in October last year. beautiful trend down, cycle down. So, you could have bought puts or put spread, nice trend to capture to the downside. But the other thing great is that see the implied volatility is moving up. So as you're going into an earnings release, you want to be buying options, not selling options, because you want to take advantage of that increase in the implied volatility that you can see there. Now, as you get to that earnings date right here, it comes out, they release their earnings, and then here it was right there, and then it collapses down here. You can see the collapse in implied volatility, and then here's Amazon starts trending back up. So in Amazon, in this particular situation, on the first quarter of this year, you had Amazon, here's its earnings release on this date on the 29th of January. You can see here. Now, you could have done a really nice non-directional option trade there, had a big explosive price move up, so that's a first trade. And then the third trade here was that post-earnings trend trade back to the upside. So a lot of great activity here on one stock if you really get focused on it and know the particular strategies to use. So this is really what makes a stock a potentially great trading candidate. So its past performance and the increase in that implied volatility, that really gives you some great opportunity. Now normally, the implied volatility will double, and in some cases it can even be more extreme than that. And this is what you want to look for, during an earnings trade or an earnings trade during for the release of its earnings results. You can get this fantastic spikes in price, and then you get that collapse in implied volatility. So it's a fantastic situation to take advantage of. So it's for this reason it's essential that you put together, ahead of time, a watch list of stocks that you can monitor, closely, because not every stock will have the same opportunity. Some stocks, don't tend to do much at all. They'll just be flat. Or some stocks will explode up or down. Or some stocks, won't exceed their expected move, and they'll just have that volatility collapse. So if you understand the history of a particular stock, then you can get your trading plan together as far as the way to trade a particular stock going into its earnings announcement, at its earnings announcement, and after its earnings announcement. And remember, the goal is to take advantage of that temporary rise in volatility. That's what we want to do as an option trader. So a stock, it needs volatility, and without volatility, you have no price movement, and without price movement, you pretty much have no chance to turn a profitable trade. Now, how then can you find that volatility and turn it to your advantage? So it's for this reason, volatility, I put together a process, to build a high probability trading list that I use during earnings season. And I look for high volatility stocks, and they have to have weekly options or have a monthly option where they're going to be trading that monthly option in the week of its earnings announcement. That's key. So I look at those two components, and that must be part of it right there. So, this screen will also track the following kind of data. I look again for that stock volatility. I want to know what it's doing going into earnings, where that volatility is, and the stocks that I'm looking for must trade over 1 million shares per day so that they have liquidity. Then I track that straddle cost. That's where you get your volatility number from. Basically, look at your straddle cost, and I track that into earnings. So, and then I use a pre-earnings implied volatility, and I use that to forecast the expected implied move of the stock after its earnings announcement. So that's the key right there. What is the expected implied move the market makers are making for this stock, for going into its earnings announcement? And then I'll look at the prior post-earnings moves to see, does this stock have a tendency also to trend after its earnings? So I look at all this historical statistics to look for various trends in a particular stock, and then see if that makes sense for me to trade. So one of the major elements to trading an earnings release successfully is to know that stock's implied volatility or its expected move, and then knowing how to use that information to do the trade setup. And this number is expressed as a percentage of the stock, indicating a 1 standard deviation move over the course of that stock's option cycle. And it's this statistical forecast of probability that is the foundation of an earnings trade. So here's an example of just what that looks like, the implied move. And this is on Google, just to kind of show you an example of implied volatility and what it can do to price. So now price will always start on an option. It starts at the money. So this is your normal distribution curve. If you're familiar with a little distribution of data for statistics, here's how you use that distribution curve to see what the probabilities are at certain points. And here is Google, 3 days to expiration. It's got the market makers are giving you the implied move of plus or minus 4%. So this says that Google trading at the money here, that's where all pricing starts, is trading at 500. And so the expected move is for it to be at 520 or 480 in 3 days. And the expected move is that it's going to trade between these two prices, and that's going to be a 68.2% probability theoretically that 3 days is going to trade probably between these 2 points. So by knowing that statistic, then you can set up your trade, your spread, knowing that the probability is that it's probably going to be 520 to the upside, or it's going to be 480 to the downside, and that's a 1 standard deviation move. So you know that to increase it outside of that, your probabilities of being in the money go down. So that's how you can kind of determine what kind of spread or trading strategy to set up. Now it's the implied move. This is again what the marketplace theoretically expects the stock to do, and this is the best way to calculate that move. So although it's not always 100% accurate, it's very, very useful, and it's a free trading tool for forecasting a stock's price movement into its expiration. And again, it's what the marketplace expects the stock to do in theory, but this is great, useful tools that you can use, and again, it's free on most platforms. So then I go through my pre-earnings checklist. I like to have things systematized, and it just helps me to make sure that I'm doing the right steps and not making a mistake, in setting up my trade and what I'm looking for, etc. So first, again, I look for the stocks that have to have options and have option liquidity. They must have a high pre-earnings volatility. I want that volatility to be high because I want to take advantage of that movement that it can present to you. Stocks must have had price moves that on average, I look for on average of greater than 5% over its last 4 earnings cycles or more, and a price over $40. I also want to trade, I like to trade higher price stocks with options because a 1% move on a dollar amount is much greater than if you're trading the lower price options. And I do this screen. I want to look for those stocks that have big moves after their earnings announcement. So I screen with my minimum move on one particular type trade. I look for 5% and 4% on the other ones that I'm looking for volatility collapse. And I'll show you how that works. And then I calculate. I got to do that implied move, that calculation there, so I can set up my trade and know where the potential movement will be. And then with that information, I perform my price target analysis and then select the appropriate, weekly option strategy, my entry plan, and my exit plan. Put all that together. Now here's a worksheet that I've put together that I use for every earnings trade that I do. And you can see here that this was on NFLX, and the key here is that you'll see that this is what I look at. So here's the implied pre-earnings move. This is the day before, the day of the earnings announcement. This is where the close was approximately. So this column shows you the past 8 cycles here, and this shows you the expected move over those past cycles right here, this information. So I keep track of that information. Down here you see the average of it. So the expected move for NFLX on average over 8 cycles has been 11%. Now its last earnings we had just recently, it was 9% expected move, and price was at 475. Now this is the key. So what did it do at expiration? Where was price at expiration? Well, you can see here over 8 cycles, the average of that is almost 13%. So this tells me that Netflix tends to exceed the expected theoretical move that the market makers are giving you. So here you can see it exceeds that by almost 2 percentage points. So what I do then is I have a certain strategy that I want to take advantage of for being inside this expected move here to capitalize on that, and I'll show you that in just a second. But this is what I go through this process. So here's Amazon, again the same process. And Amazon, you can see here the average over 5 cycles has been about 7.7% expected, what they expected the market to, or Amazon to do, and it tends to always exceed that expected move. So this tells me the type of trading strategy to do for a non-directional trade. So then step 4 is, what do you use? Well, again, I've been talking that I want to use those weekly options, and the weeklies, are still one of the most lucrative, trading opportunities that we have today, due to their defined risk, low cost, and really highly levered returns that they offer you. And the mechanics that do that, again, come back to 2 really basic components, and that's time value and implied volatility. And it's the combination of these elements, when used correctly, that really can create these winning low-cost defined risk trading formula for you that will really generate some unmatched high great returns for you in a short period of time. And so if you've seen a time decay graph here, here's a weekly option, and you can see how it accelerates and just falls off the cliff, and before you know it, you're at zero. So you want to be aware of time decay and the period of time and how it affects your price of your option, and take advantage of it. So if you're buying options, you better be aware that you're swimming against a really swift current here. So you want to be aware of that, and then try to take advantage of that time decay with the option strategies that you're using. So again, if you know which weekly option strategy to use for your earnings trade, how to construct the trade, and when to execute the trade, then weeklies can produce some fantastic, really incredible leverage returns, and in a very, very short period of time. So really making it a fun, exciting earnings season for you, rather than sitting on the sidelines. So then how's this done? Well, I've got 3 different strategies I use for an earnings trade. And when I'm calling earnings trade, I'm calling these non-directional. I'm looking at these trades the day of an earnings release. And then, when constructing the option trade, I look at the risk to reward on the 3 different strategies that I'm using, compare those, risk to reward, and then see which one, looks the best to me, and then I will usually go with that one particular strategy. And there are times, though, when you'll have more than one strategy that you can employ. So that's kind of one of the steps that I go through as well, is just compare that risk reward of the different strategies to see, does this risk make sense to me versus that reward. So here's 5 earnings cycle seasons on one particular non-directional trade that I like to do, and I'll show you this in a minute. So you can see these are very short duration trades, 2 days, 4 days at the max, and the returns, this is a real high probability trade setup that I'll show you. The returns are about 20-25%. Sometimes you'll get a bigger one, but they're very consistent, really quick returns. And then here's the July last year, kind of the same, short duration trades, 13 to occasionally you can get a really big one based on the way you structure it. And then here was October last year, 4th quarter, 1st quarter this year, short duration trades, and here's this quarter so far, the trades that I've done with this specific strategy. So 2 days, 1 day. In Amazon today, that'll be a full profit based on where it's trading now, so that's going to be a 25-30% return at the end of the day today. And that was put on yesterday, and that will be taken off today. So what is the strategy, and how does it work? Well, again, there's several methods to capture profits from extreme price volatility that surround an earnings season, and each method works best based on certain circumstances. So I don't like to spend a lot of time watching the screen all day. So this particular strategy, I can just, once I do my homework, put it on, and not have to worry about it, usually. So this strategy, I'll show you next. And again, this is probably, I'd say, my favorite. And this takes advantage of explosive price movement, not really volatility collapse. So basically, it's just 4 steps. And you're just going to buy 2 options, and you're going to sell 2 options. Now, it may sound like a lot of steps to some, but, once you understand the method, it's very simple. And the biggest thing about it is just to have that list of stocks that makes sense to do this particular strategy with. It's all about probabilities. So once you understand that, then it's really pretty simple. So this is an example. This was on Amazon, and at the day of earnings release, Amazon closed at $337.15. So step 1 was to buy an Amazon 345 call, and that cost $660. Step 2 then, part of step 1 was then selling a call against it, the 350, and that you collected $495. So your net cost, this was a debit of $165. So this was basically a vertical call debit spread. Now step 2 was buying the Amazon 325 put, that cost you $620, and then selling a 320 put against it to finance, to collect some income revenue in there to offset that cost, and that cost $165. So again, a net debit. Now, the total cost and where your profit comes in is the width of that spread. So Amazon, the 350, 345, that's a $5 wide or $500 wide spread, less the cost of your trade or your capital at risk. So those 2 debits totaled up to $330. So your net profit was the difference. So $170 per contract for that particular structure. You know your risk going in too, which is the key of 330. If you did nothing to protect that or adjust it, that's the most you could lose. You know what your net profit is, and that's what this particular trade made. So the trade made $170 per contract before commissions, and it was a high probability trade setup based on me looking at the prior statistics. Now the maximum potential loss was your capital at risk, and that was $330 per contract, so you knew that too. So I like to have everything defined risk, know where my profit is, and then have a really good statistical profile on those stocks that I'm trading to see what the probability is that this particular trading strategy will be profitable. So the trade in this particular case took only 1 day. So if you had $1,650 to invest on a particular trade like this, you could have bought 5 contracts times your $170 profit. That was $850, or a 51.5% return, 51.5% return in just a 1 day time frame. So the trade itself took about a half an hour to put on, just putting it in the market, working a little bit. But the key part was the stock selection. So bottom line, this strategy is the iron condor, and it's a great non-directional option strategy. It's ideal for trading an earnings release. Now it can be used to capture explosive price moves that exceed 1 standard deviation implied move the market makers are expecting. Or it can also be structured to capture a volatility collapse that happens after an earnings release, or in some situations, both. So here's an example of Bed Bath Beyond, the one that we did this earnings cycle, and you can see here, going through that statistical analysis again that I showed you earlier, this is what I look at. So what's the expected move for the market the day of earnings release? And here was Bed Bath Beyond was 77.68. The market makers were saying it would go 5.67% up or down after earnings and into the option expiration. So this was, I think, 3 days. Now I go back and I look. Okay, so then what did it do in other cycles? So here's 5 cycles that I reviewed. You can see 8%, 8%, 6, 7, 8. These are the expected moves that were given in these cycles. So that averages up to just a little under 8%. Then I think, okay, well then what did it actually do at expiration of those weekly options. So I have that statistics. I look at those and I can see, well, this cycle it went up over 13%. This cycle was down 8%, over 8%. Here it was down over 9, down over 9, up 10. So this thing really moves, has big movements into expiration. That's the key. Now, that tells me to do that iron condor that I just showed you. So I want to buy something inside of this average move that it has. And this particular trade I set up based on this, put it in at like basically a 5% move is what I calculated and structured the trade on. And this is what it ended up looking like. So the max debit on this trade, this was buying the 79 calls, selling the 81, buying the 75.5 puts, selling the 73.5. So here's your iron condor. The maximum, my profit, my capital at risk though was $1.40 or $140. So here's the potential profit, $300 on 5 contracts, max risk $700, high probability trade based on those statistics I just showed you. And this is what it looked like after when the trade was structured. So here's your call debit spread. Here's your put debit spread here. Here's your implied volatility. You can see it pushing up into earnings. Here's the earnings date, and then here's the day of earnings, and then the price spiked down, implied volatility collapsed. So you could have done 2 different types of structures here, but this one worked out just fine. And here's where it was right at the close, right at that strike that I needed it to be at, 73.5. So here's what it looks like on your, when you put it on your analyzer. So here are your wings right here. Just need it to be either above that or below that price level, and it's max profit. And this turned out to be about a 40% return. So my capital at risk was 140. Ended up making $55 a contract on that trade. Now here's also Netflix, same type of situation. If you look at Netflix, you can see the same scenario here, how this panned out. The expected move the market makers were given were 9%. You can come back here and look at its price history, and it tends, those averaged out at about 11. At expiration, here's what Netflix tends to do. It tends to exceed that move. Only this one time did it not exceed at least 5%. So this tells me then the kind of trade I want to do, and that's that particular iron condor I just showed you. So set that one up, high probability trade, and here's the call spread side, put spread side. Here was the expected move up here at 9%, and you know what Netflix did? It was up 20% the next day. So this thing just blew right through this trade setup, which was perfect for the structure, and it was max profit, no worry. And that was all based on knowing the statistics behind the trade. And here's what it looked like. As long as it closed either below that strike or that strike, you're home free. So this was another condor setup just for that explosive price movement. So will every trade be a winner? I wish they could be, but they're not. But in this type of trading, it's all about the probability of that particular stock and what it's done during its past cycles of earnings. And with a high probability system to analyze, you can have very high percentage trades that are winners. So it really comes down to being very selective and systematic about selecting the stocks you want to go through. So that's the key to it. So I put together these lists of stocks, and then I really focus on what did it do going into earnings, what did it do after earnings announcement or on earnings announcement, and then what does it do post earnings. So that's the key to this kind of strategy. So what I wanted to review here today, and again, apologies for the earlier mess up with the technology issues, but so if I rush through, I apologize. I should have some good time here, though. Kevin was graceful enough to get me some extra time, so I should have some good time here for some questions. But I wanted to just show you, how to start looking at volatility and use it to your advantage. The screening process that you might want to look at, put together a checklist, be very systematic with your trading, to review the trading tools that really make these things happen, and then that one particular strategy that I really like for explosive price movement, and it's a non-directional. So that being said, I know a lot of you guys here don't know me at all, so if you just take a few minutes here and just read a few of my comments from past clients and members, I appreciate that, and then I'll get into all your questions as well. A lot of great questions I'm seeing here. So just take a minute or so. We've got a little bit of time. Thanks, John. I appreciate it. Man, when you're trying to get everything done right, it's just sometimes a little frustrating.
Hey Larry, I just want to jump in real quick. Just to let you know, we're going to give you till 11:15 so you can get an extra 15 minutes to finish up your presentation.
Oh, okay, Kevin. Thank you so much.
No problem.
Okay, so I just wanted to share a few of these comments with everybody here. Now, what I want to show you next is what you can start doing right now to take advantage of this earnings season and also earnings seasons that are coming up. So you've got to start someplace, but I want to give you a really great opportunity today, and this will get you started. So let me just show you this, and then we'll go into all your questions. I see some fantastic questions. So if you can use here, I'm going to give you this link, and this course. Now, I also want to say this course, if it doesn't work for you, just send me an email, and we'll give you your $97 back. But there's the link right there. So just put that link in. Now, what I'm going to do is also give a bonus for the first 55 that sign up here today, and the bonus is going to be this. I'm going to give you this earnings course I just did this past about a week ago. It finished. It was a two-part course. And it turned out it was a 3.5-hour course. It was all recorded, and then I've got it broken down in 30-minute modules. And then you also get my 209-page training manual that's very detailed. I like to visually learn, and that's how I teach visually. So I go through different trade examples to show you these particular strategies. And then what I'm going to do to really give you support is I'm going to give you a live follow-up Q&A. It'll probably be in a week, maybe 2 weeks. Give yourself some time to get into it. I want to keep the group, small enough, 55. So that's the max I can do here today. And then another great bonus that you're going to get is my trading worksheet, or my trading list of stocks that I go to, my go-to earning stocks. So rather than you having to do the research, I do it for you, and I'll give you. There's going to be 5 different lists of various stocks, based on these particular scans that I do, looking for either big 5% moves or greater, or less than 5%. So to use the strategies that I teach in this course. So use that link, and again, the first 55, you'll get those bonuses. So let's go through here. Now again, this is a win-win situation, because if it doesn't work for you, you got the course, you went through it, send me an email, and we'll send you your $97 back. So it's totally win-win in your favor there. So again, that first 55 here today will get a live Q&A follow-up. So this will be hour and a half Q&A, and that's where you can really get into your questions. And we can also go through trade examples to show you some of the trades that we've done already this season. And then you're going to get my earnings watch list. There are 5 watch lists that I do. So you'll get over 50 stocks, and you'll get the ones that I really like to go to as well. Those are really highlighted, and I use 2 different screens for this. One is a 5% move or greater over certain earnings cycles, and then one of a price movement of 4% or less. So this helps you decide: do I want to do that iron condor for an explosive price move, or do I want to do a trade for a volatility collapse? So this gives you those particular stocks, so you don't have to really be doing all the research yourself. So that's included. And then in the course, you get my 3 favorite non-directional option strategies. They're all well-defined risk strategies that are non-directional, so go through great detail. Now, each strategy is explained in great detail with lots of examples. Then the big part of this too is the construction. And for non-directional trades, the big part of this is projecting or putting together that pre-earnings implied projected move. So this is a big part of the course. Spend a big chunk of time on what that is, how you calculate it, and then how do you construct the trade based on this information. The other big part of the course is actually the research part, to show you how I go through and select the stocks that I'm looking at, and then how you do these calculations, how you structure the trades, and then you also get my resource for all my statistics. So that's all included in the course. Then how and when to set those trades up, how to manage those trades into expiration, how to defend. I've got some defense strategies if they go wrong. You get my earnings statistic resources for earnings history, which is a big part of this, and then how to use the statistical information once you have it to analyze those trades. So the other thing I give to you is a trading library of 32 trade examples. So I like visual, kind of information to see, well, how did he do this? How did he do that? Does it make sense to me? Is it something I'd want to do? So you can see the usual suspects here: Google, Priceline. These are all trade examples to show you how these the process that goes through, to set them up and then put the trade on. So all this here for you guys here today, $97. And again, for the first 55 here, to give everybody a good opportunity, you get those additional bonuses. So there you go. And let's see some questions here. This is a one-time charge. Yeah, $97, and it's a very current, recent course, 3.5 hours. I don't think you'll ever find an earnings course out there that's this good, period. And for the price, you won't find one at all. So I put a lot of time and effort into it just to make sure that it's very clear, so you know the process of it. First off, what to look for, the research that you need to do, and then how to set those trades up. How far in advance do I put these condors on? Okay, I put these on. I'll start, working on them an hour before the close. I'll go through basically an hour before the close, and I'll put them on usually 30 minutes before the close. And I have a virtual trading room too, so we do, in the trading room, we'll go through and do these trades. I'll do these trades together. I'll show my members in the trading room what I'm doing, and then it's pretty easy for them to follow along. That's probably the easiest way. So once you sign up for this course, I think you'll get probably an opportunity to join my trading club, which is only $7 for the first 30 days, and then you can come into the trading room, and I go through this whole process and basically step you through it. So that's a really great plus too. Win-loss percentages. Well, you could see those trades that I just showed you. Probably 85% winners on this particular strategy. So far, the trades I've done this quarter, I've had 100%. I've done, I showed you the trades this quarter. Did back on a few slides back. It was Bed Bath Beyond, Netflix, Amazon, and Chipotle Mexican Grill. So they're all 4 winners, 4 trades, 4 winners, 100% so far. And then we did one that was a volatility collapse on Facebook. So that was another one. The average gain versus loss. Well, the average returns on these, you can see they're lower. I mean, lower being 25-30% return, and if you had a loss, that would be 100%. But I will usually take them off before that. I'll cut them in half, 50% off. Yeah, but again, the great thing is this course is $97, so you can't even go out for dinner for 2. Plus, if it's not something that you think is doable for you, send me an email. But also, just within the course itself, you're going to learn a lot about options that you did not know before. So it's just a great course on some of these option spreads and how to use these option spreads, that you can use these same option trading strategies for other types of trades. It doesn't have to just be for the earnings. You'll see, hey, I can use this for this particular situation or that situation. Now I know what the expected move is. I was always wondering what is a one standard deviation move and how's that calculated. This is all laid out in the course. So you're going to be, educated up the curve just by taking this course. Do I use toss market maker move to calculate the strikes? No, I don't use that one. I use their expected move, or I just do uh, the calculations myself using the straddle cost. Or the other way to do it is using the delta of the options. I show you that in the course as well. This course does show you adjustments. So these trades are real fast, but I do show you two defensive strategies, two adjustment strategies in this course. So you get that as well. I'm new to this. Would it be too much for me to buy this course now? No, it would not be too much. Go ahead and buy the course, because how are you going to ever start unless you start? So get started now for $97. This is the perfect place for you to be here today, and perfect way to get started. So go ahead and sign up. It's an investment in yourself. Don't wait. Just go for it, man. Just get it. Go for it. Yeah, David said it's a no-brainer. I'm in. I mean, $97 if it doesn't work. But please don't. Yeah, this is a 3.5-hour course, so hopefully you guys will get a lot out of it, where you're going to say, wow, this is the best $97 I've ever spent. And that's the way I want it to be for you. I like to over deliver, and so that's how I set my courses up. Now, this course was supposed to be 90 minutes, and it turned into a 3.5-hour course with all the PowerPoint slides plus these bonuses, and all the research done for you for the stock list for you guys. If this is so great, why am I sharing it with you? Because I've been trading for over 30 years, and I've made a lot of money, and I'm still making a lot of money. And I really enjoy teaching others. It's a very, very rewarding, to do kind of a coaching, mentoring. If you've ever been a teacher, you understand this, the rewards you get from just helping somebody make a difference. And so I know it sounds cliche, but it's a win-win for me, because I am making good money, but I'm also really enjoying what I do, teaching what I've learned. So I like it. It makes me feel good, and it's really challenging too. Trading is mentally challenging and stimulating, and I love to pass on what I know, and I learn also a lot from people that I'm around each and every day. So it's not like I have all the answers, but I just give you what I do know, and I've made a lot of mistakes. So a lot of what I give you comes from the mistakes I've made, and that way you can hopefully avoid those mistakes.